Pensions are a part of every employer's benefits offering, and like many other areas of reward and benefits, they have been hit hard by the coronavirus outbreak. That impact will be felt not just as part of the immediate crisis, but also in the longer term as pension schemes and providers work hard to engage or re-engage members with their retirement savings. Then there's the broader challenge of encouraging employees to see saving for retirement as a crucial part of their wider financial well-being. I'm Maggie Williams, Content Director of REBA, and over the course of 3 podcasts, in association with Scottish Widows, we'll be exploring these topics in more depth and asking how both employers and providers are addressing them. In this first episode, we'll look at the effect of coronavirus on employers, schemes and their providers and how they are responding as a result. I'm joined by Joanne Fairbairn, Head of Pensions at Marks & Spencer, and Robert Cochrane, Retirement Expert at Scottish Widows, to find out more. Retailer Marks & Spencer run a large and growing Master Trust Defined Contribution scheme managing over £900 million in assets for its 75,000 members. Joanne explains the many different considerations that have hit the scheme all at once.
For defined contribution members, the key concern is about the fall in investment values and how that's potentially impacted their fund values. Stock markets have probably fallen by between 20 and 30% since the start of the year. But from a pension scheme perspective, the key point to remember here is that most people invest in a scheme's default fund, and also that this type of fund is generally linked to people's ages and therefore has a lifestyle approach. So that therefore, as a person gets closer to retirement, the investments they offer are lower risk than at younger ages. So if your members are relatively young, it means that they have a long time to go before they need to retire, and therefore there's a significant amount of time for them to regain any losses that they might have incurred over the last few months. And then for those people who are closer to retirement, their fund values are likely to have fallen by much less, and therefore it won't take as long for them to be able to recover any losses that they may have had. So I think the key point here is to alert members to this logic so that they don't start making knee-jerk decisions to start taking their money out. In fact, arguably, now is quite a good time to put more money in rather than taking it out, because if we believe that stock markets are at low levels, it's a good time to actually go in and invest while prices are cheap. I do think, though, that for those members who are very close to retirement, so they're sort of looking or were looking to start drawing money out in the next 12 months, then it's time to sit back and actually get new fund values to see what the impact might be, and therefore whether they may need to postpone those decisions or potentially put more money into their funds to be able to meet the income levels that they were hoping to get. Another key issue from a member perspective, and this is quite an unfortunate one, is that we are hearing that individuals are being targeted by scams. So being contacted by random organisations or individuals telling members that they're able to get their money out of the scheme now. And of course, what we want to do is make people aware that unfortunately these firms aren't as genuine as you'd like them to be, and that there can be real financial consequences if they do try and take their money out early from a pension scheme.
Pension providers too have had to adjust quickly in the pandemic, both in terms of their own working arrangements and meeting the needs of scheme members, as Robert Cochrane of Scottish Widows explains.
For providers, I think the responses have been twofold. There have been operational issues and then responding to customer reactions. Operationally, we've obviously had the safety of colleagues at the very heart of what we do here. And individual call centres and individual operational centres have had cases of COVID-19 and have had to react to that. So that's meant that we've very swiftly had to try and move to a virtual environment. And some parts of the business have been really successful at doing that, transitioning within just a few days from head office base to entirely virtual, people working from home. Consistency of service has been a key challenge there, so trying to make sure that we're still answering calls, make sure that we're offering our customers the support that they need at a time which is of considerable stress to them. That whole operational area was really key, and that's right across the entire business. So all providers will have had those different operational issues and responded in different ways. And then it's about customer reactions. So how do we respond to how we see customers reacting? So fairly quickly and early, when we saw the stock markets fall, we saw things like an increase in fund switching. We saw an increase in telephone calls, people phoning in, worried about the funds, not sure what was going on, just seeing all this everyday doom and gloom, the market's falling, not sure how to react to that. And what we quickly then had to do to respond is to create video content from our experts and then put that online, share it through our social media channels, just to try and calm people down and reassure them that pensions are a long-term savings vehicle. And because they're a long-term savings vehicle, you've got to expect fluctuation. Interestingly, as a business, Scottish Widows were actually set up in a time of crisis. We were set up in the Napoleonic War to look after the widows of the Napoleonic War. So this feels like what we do.
Even as employees start to return to work, the effects of the pandemic on pensions and financial well-being will be felt for some time. Employers have a major part to play in supporting employees, and Robert explains some of the ways they can help.
I think what employers can do is, first of all, take advantage of the resources that are available and promote them to their staff. So some of that's things like PensionWise and government agency. Everyone over 50 is entitled to a free session with PensionWise to review their retirement options, get the guidance they need and the help they need so they can come into the workforce. Maybe not at this point in time, but as a general rule of thumb, they are somewhere that employers should point their staff towards. You should also take advantage of provider support. So we have frequently asked questions that people can come and see, which may be their questions and maybe help direct them in a way that supports them. We have things like virtual educational sessions, and we have those recorded as well. So, and just to give you some figures, yesterday we ran one, and 390 employees from one employer all joined a webinar and asked 105 questions. So we can see that there's a demand for this. It's about promoting it from the employer with their provider to make sure that their employees are getting the help that they need.
Joanne and her team at Marks & Spencer have also been working hard to further help their scheme members over the longer term.
One of the key areas that we think we can help them is on the communication side. It's really important that our members don't get panicked into making sudden decisions about an investment that is a long-term one. And we've already discussed earlier about what the impact of falling investments could mean for them, and that perhaps in the long term, it may not be quite the concern that they might perceive it to be. So we're pulling together communications to colleagues to try and reassure them and stop them making sudden decisions. Linked to that is colleagues who may be wondering whether to pull out of the pension scheme altogether. For example, if they're suffering financial hardship at home, you've got to remember it's not just our colleagues, but potentially the whole of their family circumstances. So we're looking very carefully at what the opt-out rates are at present from our pension scheme and how they might change over the coming months as any financial hardship due to coronavirus might kick in even stronger. Because whilst we recognise that people may need to opt out in the short term, we don't want that to mean that they don't then come back into the pension when hopefully the situation becomes more stable financially for people. What we'd like to do is take the data from people who are opting out and proactively encourage them to rejoin somewhere down the line. Now, obviously, I'm not quite sure where somewhere down the line is going to be yet. It depends on how things pan out during the year. And there is the 3-yearly auto-enrolment process, which will, of course, capture quite a number of people who opt out today and automatically put them back within the next few years. But actually, I don't want to wait a few years down the line, and auto-enrolment doesn't capture everyone. So once we get back into stronger financial circumstances, I do want us to be communicating with those individuals to see if we can encourage them back in to restart their their longer pension savings with us.
Many thanks to both Joanne and Robert for sharing their insights on pensions and the coronavirus crisis today. As I mentioned, this is the first in the series of 3 podcasts, and I look forward to welcoming you to our second episode, where our speakers include Ross Matthews, Director of Pensions and Benefits Europe at Centrica, to talk about pensions engagement.